Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at RTX Corporation, ticker RTX. Previously Raytheon, they split Otis, their elevator segment, off into its own company and became RTX. 2 to 3 years ago? They had earnings last week, so I wanted to take a look and see what we're looking at for this stock. And I'm coming up with a value, and there's agreement almost across the board of mid 130s. 132 for the fair value, 134 discounted cash flows, 135 for the retained income model. Currently trading for about 201 down to 200 exact after hours on Friday. And that's something I really want to look at. But in the last 52 weeks, it's been as low as 112 and as high as 205. So they hit their peak and they're on somewhat of a decline right now. We'll take a look once we talk about some of the fundamentals. But is it a stock that I personally would want to hold? Not for the growth you're getting out. I mean, we might be able to adjust some of these numbers, but we're looking at 5.7% growth in the share value plus a dividend, which right now is yielding 1.3. So you're looking at a total of 7% return. Underperforming the market by 1 to 3%. So not really something that I'd be looking at. And then you have the ROI and ROA, both 3 and 4%. Again, that's just, there's better options out there. Earnings yield, 4.7%. So what you're paying, this $200, you'd really want $10 in EPS. And that is not what you're getting. They came in at $5.02 last year, expected to do $6.78 this year, and $7.51 in 2027. So that $10.05 you're looking for, probably not going to see it for a good 4 or 5 years with how things are going. And then we can come over to PE. PE is currently 29.64. Over the last few years, they've been about 23.5. For my calculations, I put in 20 as the PE to use for the earnings valuation. 15 to 20 is what you typically are looking for, and you can add a little bit more onto that if they're going to overperform the market. But that's not what we're looking at here. We're not looking at market overperformance, so 20 PE is completely reasonable. They're 10 above that. Growing their earnings at 10.8%, which gives them a price earnings growth of 2.75. And you want that as close to 1 as possible. So on all fronts, it looks like it's overvalued earnings-wise. Dividend gives another hint that it might be overvalued right now. 1.32% is what it's currently yielding. On average, over the last few years, 2.4%. So that yield has almost been cut in half, which means the share price has gone up way faster than the actual dividend amount. Payout ratio this last year, healthy, 49%. We like to see it 30 to 50. It was in there. If they don't raise their dividend off of their expected earnings of this year, they'd be down to 36.58. So again, that'd be the lower range healthy. We'd expect them to continue growing. They grow it about 7% per year. That's why we have that in the dividend is healthy, but showing signs that the stock might be overpriced. Cash flow yield, this is good news. This is part of why the stock is up. 8.4% on average, 6.66. So they are doing better with the cash that's coming in, converting revenues into cash flow. And their margins are up. Gross margin 20.1 on average, 19.3. Net 7.6 on average, 6.5. So those margins play into the cash flows to everything. If they can continue growing those margins, things would be a bit better. You don't need to grow the revenues as much to really see a benefit across. I like to see 20 and 10. That margin's still not really where I would like to see it for them. We touched on a few things. We can get into the rest of this thesis here. And then I want to take a look at the technicals as well and what I'm going to be doing about this stock. So we've seen them grow in revenues really well. 9.7% over the last 3 years, 13.4 over the last 2, but analysts are expecting a slowdown, 5.3 and 5.8 over the next 2 years. On the lower end of that, 5.3, can they hold that out for 5 years? That's what we're putting in for our thesis. Share count, there was talks from the government about not allowing buybacks from specifically defense companies who are government contracts. I don't want to mess with this number too much. They had a big accelerated buyback program that they had done over the past few years that ended in 2025, and I'm not seeing any expectations for buying back going forward. But when you look at the numbers, they had more shares at the end of 2025 than they did at the end of 2024. I have their earnings pulled up right here. Shares outstanding. Basic shares will go the 12 months ending 2025. 1,341.4. 2024, 1,332.1. So shares were obviously issued over the course of 2025. We see that there. Hopefully they don't continue that. I'd like to see them hold this flat because there's a massive impact. If they issue another 0.04, watch this. We have our average returns right now of 5.7. Now they're 5.3. Now your total return is 6.7. But vice versa. If they buy back 0.5%, we don't even have to do half. Let's just say 0.4 in the other direction. Well, now you're looking at 6.1 and 7.4 overall. I'd really like to see them buying back, but that's not what we're seeing from them right now. And I don't see any expectation that they will. Seems like there's more pressure that they don't. Cash flows, they could grow all the way up to in line with revenues, but 4.3% gives them 8% cash flow yield, much better than they've done on average. That way we're not putting too much hope into a continuation, and this year might have just been a high year. Assets are very consistent, around 2.5%. Liabilities all over the place. Last 3 years, up 7. Last 2 years, up 2. So 2-3%, probably somewhere in there is what we'd be looking at. So I did 3. If we make that 2%, let's see, come in line with what they did last year. So our 5.7 moves to 5.8. We can keep that and see how things play out. Dividend, they're very consistent. They're out raising close to 7%. And then margins, we'd see a small increase in those. So what we're looking at there, average returns of 5.8%. Once you factor in the dividend, 7.13. Well, I don't want to underperform the market with my stocks. So I'd want about 9%. 8 to 10. 9's the midpoint. 9 would be what I'm looking for my stock. Well, with these growth rates, this thesis here, if we're going to make up for that with a dividend, we'd be needing a yield of about 3.2%, which would be buying shares at $77, almost $78. And that's why I'm leaning away from adding this to my portfolio. I don't think that it fits the criteria that I'm looking for and is completely overvalued at this point. But we can look at it technically and see, is there a way to trade off of this information? And I think that there is. So when I look at charts, I like to look at candles, moving average, volume weighted, average price, and then the RSA and MACD can give a little bit more information. But what we're looking at here, super strong support down here at 114. They broke above it and they've retested it multiple times. They tested it right before they started this massive run that they've been on for the last 9 months. So I'd say if it gets down to that level, and that's where I would be playing long, potentially buying in, selling a put credit spread, something like that. And then we had somewhat of a ceiling back in that time frame early last year. March, they did 3 touches at this point, which just so happens to be 135, right about what I deem to be the fair value for the stock. Discounted cash flows, retained income, and my mixture of balance sheet, earnings, dividends, all put this stock about 135. So that is something to note. It broke clear through it as part of this massive run that we've seen it go all the way from 114 at the end of April in 2025, all the way up to 205 this last week. It hit this 205, and it's been on a bit of a downtrend since then. It was a high point. If we use that as the peak, the start of the run, as the other end of a Fibonacci retracement, which it's always amazing how well these things line up with the chart. We see that the 61.8 level, massive support. It was trading sideways, came down, bounced way up. And that bounce brought it to just about the 38.2 level. But then it came back down and it closed in October right on the 50% level and gapped up the next morning to open at the 38.2 level. Came back down gradually to find some support around 170 and pushed all the way back up to 200. And so what I'm looking at on this one is if this trend continues. Right now, after hours, it's at $200 exactly. If I see it close below 200 on Monday, Tuesday, then I'd be looking at a call credit spread for Friday, saying stock's going to close below 205. And that's how I would be trading this. Now, if it continues this downtrend, the moving average is down here at 193. It can go down to 193 pretty quick. And then we'd start to see lower lows after this support that we saw back on the 26th. If that's just the start of a downtrend, I mean, it rose so violently, or it rose so quickly, it could go down very quickly too. You know, we'd be looking at support around the Fibonacci levels. So 170 would be the next. So if it goes down 193, then 170, breaks below that, 160 could be a reasonable price to see this thing in a few months if it starts to downtrend after these earnings. Now, I don't think 160 is a great price. I would like to see it continue lower if someone were to be buying into it. You know, 160, we're looking at a 3-year fair value of 141. So you're taking your current fair value, you're growing it at 5.81% plus your dividend, and this does factor in the growth of those dividends. You're looking at being overpriced by 6% at that point, while the rest of the market is up 26%. And then in 5 years, you're looking at 156 for your fair value. So your dividends give you 7% beyond, and you're underperforming the market by 40. Now, as I've said before, if this thing's trading at a multiple, if it's currently trading at its 4 or 5 year out values, in 4 or 5 years, it could still be trading at the 4 or 5 year out values. So I'm saying, you know, in 3 years, it's trading at its 6-year valuation. So we'd be looking at 165 plus probably another $4 in dividends. Fundamentally, it seems to be very overpriced. It's been on such a momentum run that, I mean, we just saw it with silver this last week. When you have a massive momentum run and things start to turn south, they can go south quick. I mean, silver was down 30% on Friday. So this isn't a stock that I'd be wanting to buy, but it's a stock that I think that I could probably trade. And that's what I'm looking at on this one. So I want to thank you guys for watching. Please like if you enjoyed the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.